Welcome back. You're watching Your World at 10. Now, over the last week or so, the financial system on both sides of the Atlantic saw some pretty crucial events take place. On Wednesday, US President Obama signed the regulatory reform bill into law. And then on Friday, you had the results of the European bank stress tests. 7 out of 91 banks, only 7, failing to make the cut and requiring an additional $4.5 billion in capital. Meanwhile, wrangling has already begun on the new capital requirement norms being considered by the Basel Committee of Global Banking Regulators. So it's been a cause and effect month. We've had the FinReg bill, in a sense, deal with the cause of the last crisis, and the bank stress tests, in a sense, deal with the effect of a potential next crisis. To discuss the status of the global financial system tonight, we're joined by Charles Dallara, the Managing Director of the Institute of International Finance, the world's only global association of financial institutions. Mr. Dallara, thank you very much for your time. Let me start by asking you what you make of the results of the bank stress tests that were announced on Friday in Europe. Do you believe now that the weakest part or the weakest period of the global financial system is behind us?
Well, good evening. It's a pleasure to be with you. I do believe that the results of the stress test on the European banks is encouraging. It indicates clearly that the wide bulk, the overwhelming majority of European banks are well placed to face additional stress should they emerge in the economic or financial landscape. I do not believe that these stress tests are particularly weaker than those that were conducted by the United States a year or so ago, as some critics have charged, but rather believe that the stress tests are a sensible barometer of how these banks would perform if faced with either another economic downturn or other financial stress.
Do you believe that we're faced now with almost no likelihood of a large financial institution failing in the developed part of the world? Because we've seen the US government actually cash out of Citigroup, make a neat profit, if I may say so. We're seeing positive stress test results out of Europe. So is it possible that there is almost no chance of a financial institutional failure now going forward over the next 2 or 3 years, irrespective of how slowly the global economy recovers?
Well, I would say that one could say something rather close to the way you framed it. I would think that the odds of a failure of a major financial institution at this stage is extremely, extremely low. But we are in an interconnected world, and I do believe that it's important that the global recovery be sustained. I believe it's important that the countries which are coming under fiscal pressure now demonstrate their resolve to tackle their fiscal deficits. The G20 showed at its recent meeting in Toronto that there are wide ranges of views about how to tackle the current conundrum, that is, sustaining the recovery while tackling fiscal deficits. And governments will have to be very careful to move down the path of more fiscal consolidation, in my view, in order to ensure that the rebuilding of market confidence continues. Whatever the path, however, I think that you're basically correct in the point that the odds of any major financial institutional failure are extremely low. But at the same time, we should not take for granted that confidence will continue to be restored unless governments follow through, both with impressive fiscal reform, as you're seeing now in a number of governments in Europe, especially, I would say, in Greece and Spain, but also with important structural reforms which can enable the supply side of growth to begin to drive economic activity in some of these countries. Again, we're mildly encouraged by the measures that are on the table in countries such as Greece and Spain, Portugal and Ireland, to increase the flexibility of their labor markets, to privatize state-owned assets, to rid government structures of corruption and lack of transparency. All of this is crucial to restoring the broader framework for financial stability within which the major banks operate.
Mr. Dallara, let me shift tracks now to the financial regulatory reform bill that President Obama just signed into law. Do you believe that it adequately addresses the situation or the issue of too big to fail? Because most of the press headlines that seem to be coming out of the U.S. read Wall Street wins.
Well, I believe that the bill that President Obama signed into law contains a number of positive elements. The creation of the Financial Stability Oversight Board is one such element. There are also useful provisions in the bill on how to resolve a failed financial institution in a more orderly fashion. I don't think it's constructive, quite frankly, to view this as Wall Street either winning or losing, because the future of Wall Street is too tied to the future of Main Street for us to pretend or presume that there's really any meaningful separation over time in the performance of one over the other. The fact is that this bill does contain some useful elements. The biggest concern that I have over it, however, is the failure of U.S. authorities to adequately coordinate provisions of the bill in a global context before the legislation was signed. So now we have the not inconsequential challenge of having regulators around the world try to produce convergent regulation when they do not have convergent legislation. That is particularly important in dealing with the too big to fail issue.
Yet, Mr. De Lara, do you believe that we've come a long way from, let's say, the depths of the 2008 crisis and have, in effect, not just in the United States of America, but across the world, started to address the need for better regulation to avoid a similar such crisis? Because there are many in the financial industry that believe that some of the changes are very mild in nature, others are too bureaucratic, and nothing really will, in a sense, stop the next crisis from hitting us.
Well, it's very difficult for anyone to know what the source of the next crisis may be and whether we have erected the barriers to contagion that may be needed to prevent a crisis from sweeping across the global financial landscape again. I do believe we're moving in the right direction, broadly speaking. I believe that there are crucial measures that are still under discussion, and you alluded to them earlier when you mentioned the discussions over Basel III. The fact is that among the most important reforms that are likely to take place in global finance in this entire period responding to the crisis are not those being legislated in the United States or Europe today, but they are the reforms that are being discussed in the Basel Committee and the Financial Stability Board to strengthen capital requirements, to strengthen liquidity requirements.
How far are we, Mr. De Lara, from, let's say, Basel III? That is another set of enhanced capital requirements, maybe a year?
No, actually, I believe that we will see a revised set of proposals which will be near final emerging within the coming weeks and months. It's clear that the Basel Committee wants to be in a position, and we share that goal, for the G20 to endorse a rather clear set of changes, increases in capital requirements, increases in liquidity requirements, improvements in the quality of capital, a whole range of improvements to capital and liquidity requirements, which, if implemented consistently across the world, would have a meaningful, constructive, and positive effect on global stability. And we believe that the broad thrust of these proposals will be rather clear no later than November and perhaps as early as September. Of course, implementation will take quite a while, and I'm sure the Basel Committee will be quite careful about how they phase in the new rules in order to allow banking systems around the world in very diverse circumstances to prepare and position themselves for the new rules and to raise the capital required. But I believe that we will see a rather clear framework, a rather clear picture emerge within the next few months.
All right, Mr. De Lara, thank you very much for joining us, and thank you for sharing your perspective on the state of the global financial system. That was Charles De Lara, Managing Director of the Institute of International Finance. With that, it's time for a quick break on Your World.